What really spooked the markets yesterday, apart from FNO expiry and a bit of a budget disappointment, was a clause in the fine print. And the clause was that for those who are claiming benefits from the Mauritius route, standard higher level of disclosures will be required. What was the thinking behind this, and at a time when the country needs foreign capital, why exactly has the finance minister referred to that clause? Let's understand that, because that to my mind is an important clarification and markets would like to understand, would like to get a better understanding of that. Let me now bring on board a very special guest, Mr. P.Shome, advisor to the finance minister. Mr. P.Shome, good morning. Thank you for joining us. Now, tougher eligibility for tax treaty benefits is likely to hit the Mauritius route, as tax residency certificates alone are not sufficient for treaty benefits. Why the need for this when GAR already has been deferred to 2016? Many would say that, look, this is slightly draconian.
Well, we have to really separate the two issues. GAR is a separate issue on general anti-avoidance, picking up cases of gross avoidance. That's GAR. This on TRC is a slightly different issue, referring to section 90. And what is it, therefore? The TRC's role you can think of as has come out, and the confusion thereof, in two parts. One is, it's a tax residency certificate, so is it enough to, or sufficient to have a TRC to prove residence? And the answer is still yes. The second part is the second is the issue of beneficial ownership, and that what is being said now is that, or what is being has been said is that TRC is not sufficient to for this particular part of the TRC, and it is nothing new. It was already in the form of a circular last year. It has just been put into the Act as sufficient explanation and corroboration of already what there was, and the circular was in a position where it played a role, but probably it was not observed in the same way as it has been observed very quickly in the Act. But because of the confusion, a clarification will be issued, I'm sure, to say that the TRC is still sufficient to prove residency.
Right. Mr. P.Shome, are you not trying to bring investments routed through Mauritius under the tax net then?
No, the fact of the matter is that the government is interested in investment, foreign investment, but at the same time, while keeping all the treaties that are current, adhering to the principles in the treaties, government is of course interested in minimizing tax avoidance without shocks into the system. And it is not to say that everyone is opposed to, or government is opposed to investment through Mauritius. We know that more than 40% is coming through Mauritius and so on and so forth. So that is not the issue. The issue is where there are gross avoidance issues, in what manner, without impacting on legitimate interest investment coming through Mauritius or any other source from abroad, the administration can address these avoidance issues so that the tax burden is spread more evenly.
Right, but what happens, say, if a company is headquartered in London and operates through an agent in Mauritius? Now, can the assessing officer showcase this company?
No, the issue is there is no change. It was all, whatever is the interpretation that you are giving has been in the books in the form of a circular. What has happened now is that it is in the form of an Act. Therefore, however, that has led to some confusion. The circular or the Act, whatever you might think, is confusing, and that will be clarified. But because the beneficiary issue is not going to be a part of a sufficient condition for TRC, whatever are the implications of that will follow, certainly.
Mr. Shome, there was no mention of the retrospective taxes in the budget speech. Your own recommendations are still under consideration. Are any changes likely outside of the budget, or is the government firm on the retro taxes?
No, Finance Minister has himself mentioned that he is going to send table at the cabinet level some suggestions in terms of coming to a conciliation mode with a particular party that has been affected by retrospective application. And so he will wait for cabinet to give him some guidance about whether that is better than arbitration. And certainly the UN, OECD and so on have indicated that conciliation is a recognized mechanism for resolving disputes before going to arbitration. And so let us wait and see. Let us hope that Cabinet approves what Finance Minister is saying. And once this is clarified, then my own belief and hope is that government will be able to act on the report. But I think this process has to be completed before they can come back to it.
Mr. Shome, transfer pricing is another grey area. Though the FM is assured that the matter will be dealt with in a transparent manner, ideally it should not have been fixed in this budget.
Well, you know, in a way, you have to think of transfer pricing issues. It's not just fixing. You have to really examine it because each case is quite different. There are several cases that are coming up, and it is very interesting that the issues that come up are quite varied across the different parties, and so there is a transfer pricing unit that is doing kind of hard work on these matters. And as Finance Minister has said, once there is a critical mass of issues, I think that they will be examined rather with the objective of coming to some guidances and guidelines on this matter. So it is true that we do have to, I do believe that we have to take a look at it, but it has to be at the appropriate time. This is a kind of a new area for India, but India is following again very closely the OECD guidelines. It is looking at the MAP process with the US, and it is trying to not replicate but see and understand from the developed country experiences how transfer pricing is applied. And if it is felt that we have moved, you know, it's a new thing and we have to really look at it in some other manner, then I'm sure FM will do so.
Right, so Mr. Shome, will the mention of GST and allocation of 9,000 crores finally pave the way for introducing this ambitious tax reform?
Well, the goods and services tax is a tax that was sort of put on the back burner, I would say, for a few years, for 2 or 3 years, because of mainly from our current assessment, the misunderstanding between the centre and the states about the compensation for the central sales tax, which is imposed by the centre but collected and retained by the states. So since the rate was brought down from 4 to 2, the states have interpreted this as a permanent loss, and they have said that they want compensation at least for the period during which GST is anticipated. And otherwise they wouldn't mind going back to 4%, but that would be a retrograde step, unless we say that it is, let's say, for the interim till the point that we are introducing GST. So we do need GST, and the states in the meantime do want compensation, and Finance Minister has set aside 9,000 crore. That will completely fulfill the first year's compensation for revenue loss, and then there are some others years will follow. at the same time, while this shows that or reveals FM's good intentions, he has also agreed that the states will take that a constitutional amendment is essential, that the states agree to that, and second, they themselves, as they want, pass their GST law and sort of model law be passed in the national parliament, and then the CST will be compensated.
All right, Mr. Shome, really appreciate your time and thank you for your insights. 36 points down for SGX. Even though Finance Ministry has clarified the entire Mauritius issue, SGX is looking very listless.